Now, I do start off every show with a summary of kind of what I see happening in the stock market. Pretty appropriate today to be talking about the stock market because we're really having a big downturn day so far. And we've done some very significant things within our portfolio. As I've been talking about over the last several weeks, we've been getting sell signals on the different pieces inside of our model portfolios, and we've been moving those into T-bills and ultra short-term bonds. As of last week, we had 44% of our stock market exposure moved out into those areas, and roughly about 75% of our bond market exposure moved out into those T-bill and ultra short-term bond areas also. Again, these are things that just don't fall much. They don't gain much either. It's just a holding place until we see the market maybe settle down. We can come back in, start, hopefully buy low with those. But yesterday we did something even more significant. We moved the rest of our pieces in the stock market component out to T-bill and ultra short-term bonds, and we moved about a quarter of our exposure to the stock market into an inverse position, which just means that it actually makes money when the market goes down. And so today we're looking at a situation where the S&P 500 is down more than 2% as we speak right now. And so we're actually up on that inverse position about that same amount, a little over 2%. And I know this seems kind of strange, but we've got a scenario here where the market has been going down so much that we've decided to kind of hedge against that risk. We still have in our portfolios the legacy positions that our clients have asked us to keep. So they're still subjected to the ups and downs of what's happening in the market. And we also have some positions in our taxable accounts that we purchased for our clients, years ago that have large capital gains, and we're still keeping those. And one of the reasons to use this inverse is to try to offset some of the losses that could happen if the market comes down for those positions that we really need to keep. And so if you look at this chart, this is the year-to-date chart of the S&P 500. And you can see that blue line there, it's curving over. That's the 200-day moving average, so we're below that, so that's significant. It's also moving down. That red line is showing kind of the top trending line. You can see we touched it in March and early August, but didn't break through. So we're still in this downturn, and now that's why we're in these inverse positions because of that. But there's some things that have happened. A couple weeks ago, we were looking to try to hold that line. Mm-hmm. That was a pretty good support line, and we broke through, okay? Mm-hmm. And then we're trying to hold this line, right? This is, again, a pretty decent support level, not as big as the other, but still a support line. We broke that today, right? You can see that bar at the last day. That's today. Okay, so now what's the next level of support? And it's really the low for the year. On the S&P 500, that's 3636. Right at the beginning of the show, we were hitting 3647. Yep. Okay, so when you retest a low, you don't always get to exactly that number. You can be close, a little high of it, a little long of it. In other words, you could go to 3330 or 20 or what have you. And this is actually a fairly significant piece, and as far as that goes. But if we break through that with any type of power, the problem is the next level of support is so far away. And I have to go back to a 3-year chart here. That's the next level of significant support right there. And if you look back, you can see the big V drop that we had in 2020. But then there was 2 little drops that happened, 10% each, in September and October. The bottom of that is the next big support level. Unfortunately, that's about 13% from where we are here. So that's the cliff. I've been talking about standing on the edge of a cliff. And although we haven't fallen over the cliff, when you get closer to the edge, the risk gets higher. And so we've been building a parachute in case that risk, it becomes actualized and we fall off of this cliff and we kind of have this cascading motion downward. So again, we've been packing that parachute with T-bill and ultra short-term bond ETFs. That's been working quite well over the last few weeks. It's worked out, that we've outperformed, at least in our models because of that. And then today, if you get a chance to take a look at your account today, you might be kind of surprised because the inverse position is up so much. And again, it depends on what other holdings you have that we didn't get rid of. But if you don't have any of those, our models are showing positive returns for the day, even though this is a pretty negative day. And so that's there. And so that's the issue that we're kind of dealing with here is just where these different support levels are. Because the next one, and I got to go back to a 5-year chart here, and you can see there's a lot of touch points here. But this is at about a 24% drop from where we are today. And so again, this is the cliff. One of the things that happens, you have to understand, when the market runs up very quickly without spending much time anywhere, like we did at the end of 2020 and most of 2021, you end up with very little support, because the idea is that if I bought at this price and it went up and it comes back and I think, wow, I made money last time buying it there, I'm going to buy it again. But if it didn't spend much time at that price, you don't get much support. And support and resistance is just one of the issues that you'd want to look at with the overall market. It's a simple thing to talk about here, but we're looking at all kinds of ATR trailing stops and all kinds of different indicators that we're looking at to figure out what to do and what have you. Now, there is one other scenario here that I think is very important to consider, and that is that what is happening right now is, if you look at what's been going on, the market's come down a lot here very quickly, right? Since the beginning of August. We had one little bounce there, but basically straight down. And so this concept that I call stretching the rubber band, and I use that because the more you stretch a rubber band, the more resistance you get, right? And eventually it snaps back. There's a measure called RSI, and I use the Wilder's version of that. The RSI on the 14-day basis right now is really stretched out. As a matter of fact, and now we're down to this low, and I would be really surprised if there wasn't a lot of buying that happens at this low test, because this is what people have been waiting for. So you got that combination of overstretched to the downside and a point of purchase. I bet you we get a bounce. At least next week, that type of thing, maybe even closing today. We'll see what happens. But a bounce is probably coming. The question will be, is that bounce going to be big enough to get us back through really the 200-day moving average, which is that blue line there. And you'll notice the 200-day moving average is coming down to meet us. That's good. So is that red trend line. So the market won't have to go as far to get back through that. And traditionally, that's a sign of breaking out and starting a new trend, and we're starting a new upward trend. So we are at this kind of point of indecision. Even though the market is falling hard today, it's really falling because there's a big gap in support. And so the next support is that low point, and boom, we fell right to it just in one day. So, we'll see what happens, but it's really interesting.
Do you think if the bounce comes, it'll be a quick bounce, or it will be kind of like a slog upwards?
It would normally be a slog upwards because, you can have some strength in there, but you don't have conviction up front, so volume can be low. And unfortunately, all these support levels that we broke all the way down here are now resistance levels above us. So we got to slog through those. We're going to hit one and then sit there, and then we go to the next one and sit there, and go to the next one and sit there. Eventually, once you get true momentum, you get true buy-in and volume, you would blow through more of those resistance points a lot faster. But the main thing that would drive things will be short covering, and that's what's been going on. That big run-up that we saw from the low June, mid-June to early August, there was a tremendous amount of short covering, and you can see that very simply by looking at, the S&P 500 made 3%, and the most shortest stocks made 4.5%, or something along those lines. That kind of, at least to me, shows some of the short covering that's happening, because when you cover a short, you're buying back the stock, which of course makes it go up even more potentially. So, I would suspect that it would be something that would kind of slog. I think a real warning sign would be, though, if we fall through this low without really stopping, because we're in a waterfall fall right now. That's what I call that. Last 3 days, boom, boom, boom. If we continue that waterfall through this low next week, we're going to go down to that negative 13% from here type of thing, next level support. In my opinion, maybe not immediately. There'll be some bounces in there, but what they call capitulation, right, is what everybody's been talking about. Oh, we need capitulation for this thing to end. Could be what we're experiencing here as far as that goes. Might be some great chances to buy in there, as far as that goes. But right now, I'm not that aggressive that I want to go buying in here at this, point of resistance of just at this low. It didn't spend much time there. It's more of a psychological resistant point. There are people that are going to buy here, but we really need institutions to move in. The only people left in right now are individual investors. I just saw an article, the institutions have moved out, individual investors are still there. Once they panic, that's when you get that capitulation. And then once those institutions come back, that's when we'll really get our turnaround. So, yeah, it's very, very interesting to see what's happening right now. But just so my clients know, we have taken defensive measures to try to protect against this. And we'll continue to monitor that. It is quite easy, to sometimes get out and get into these inverse things. It's a whole nother ball game. So if you're ahead 3% or 5% or 10% where you would have been if you'd stayed in, it doesn't really matter unless you can get back in at some lower point. If you get back in at a higher point, then you might as well just stayed in, right? And so that will be the trick. And we have a whole bunch of little techniques that we'll be using to kind of get back into this a little bit at a time as far as that goes. But we've got to see this waterfall, kind of slow down before we're really going to do that as far as that goes. So anyway, that's the key message for today about the market. It is what it is right now. We're kind of unwinding some of the excesses that were pushed in there from the pandemic relief that came through worldwide. This is going on across all these markets, and so it's just something to be patient with. We have established, at least in our accounts, some good protection. We're still working through all those different pieces, but we'll continue to do so.